Kevin Dowd said the city would have to reorientate itself but added, the potential longer-term opportunities would be enormous. The Bank of England, the cornerstone of Britain's financial sector, is not necessary, and should be abolished, a radical new report has argued. The experience of free banking was published by the Institute for Economic Affairs, IEA, on the day the BO announced its decision to freeze interest rates at 5.25% as part of a strategy to control price rises. The analysis outlines a monetary system where private banks issue competing banknotes, usually anchored to a commodity like gold or silver, replacing the central bank's role. Kevin Dowd, professor of finance and economics at Durham University Business School, told Express, the book shows that a central bank is not necessary. Commercial banks can issue their own currency, their own banknotes and deposits. These could be linked to a proper monetary standard like gold or silver, and were for very long periods under historical free banking. The first task, Mr. Dowd said, was to set the exchange rate. He explained, in Argentina, they are announcing a one-off devaluation, to cushion the macroeconomic shock, and then they will replace the peso with US dollar. Here, we might devalue against the dollar and thereafter permanently fix the pound-dollar exchange rate. Or we might adopt a gold standard where the pound price of gold is fixed. Either way, we would get rid of monetary policy forever. The monetary policy side of the BO, the MPC, setting interest rates, etc., would then be redundant, and could be wound down and then scrapped. Nevertheless, it would still be necessary to address the BO's role as prudential regulator of banks, insurance companies, etc., Mr. Dowd stressed. He continued, I would phase this out by first announcing that the UK will withdraw from the big international agreements such as Basel by some future date, e.g. in 2 or 3 years' time. It would then announce that UK financial institutions have to get their capital standards up to required levels by that date or they will lose their operating license. This would ensure that banks would be capital adequate when that date arrives, and thereafter bank prudential regulation and what is left of the BO could all be abolished. Mr. Dowd said, all of this would be seriously disruptive, of course, because we would be moving from a system that is managed, or rather, mismanaged, by armies of useless regulators to a system that is much more automatic and self-regulated. Getting rid of these roles is to me a further benefit of moving to free banking. The city would have to reorientate itself but the potential longer-term opportunities would be enormous. The bank today held interest rates at their current level, which is a 15-year high, for the third time in a row and indicated that cuts are unlikely in the coming months. Governor Andrew Bailey emphasized that there is still some way to go in policymakers' efforts to get inflation down. The bank's Monetary Policy Committee, MPC, voted in favor of keeping the rate steady, with 6 members of the 9-strong committee were in favor of maintaining, and 3 calling for a further increase of 0.25%. The interest rate, which helps dictate mortgage rates from banks, had been set at 5.25% in previous meetings in September and November, following 14 consecutive increases.